Welcome to another episode of Lanterra Live. Today, it's my great pleasure and honor to be with a very good friend, Jay Smith, who's a senior portfolio advisor and investment advisor at Wood Gundy. Jay has been my investment advisor for many, many years, has done exceedingly well, and we became very good friends. I'm always very impressed that somehow or another you get it better than anybody else I've spoken to. We've had the pleasure of having you a number of times at events with our agents, and even in Switzerland once when we sort of joined with the Basel Art Fair. We'll talk about this later, that you have a very strong interest in art. But for today, we would like to share some of your wisdom with our listeners. So, Jay, we're living in one of the craziest times ever. There's, our interest rates took a little bit of a stall. People are scared about tariffs. Trump is playing games. He just signed a couple of big deals with England and EU. Sometimes inflation is up, sometimes it's sideways. We're talking about a Bank of Canada that is trying to work with the relatively new government to fix a lot of stuff wrong with Canada. The stock market seems to be doing okay. The real estate's obviously slumping. But somehow or another, you have a very distinct view of where we're going in the world. And I'd love to be able to have you share that with our listeners.
Well, first of all, Mark, thanks for that very kind introduction. You are a good friend, and we work well together, and hopefully that continues forever. The market got very nervous on Liberation Day, April 8th, when Trump put 145 tariffs on China, 25 to 50% on the rest of the world. But that's who he is. That's how he bargains. That's what he does. And some people panicked. But if you look through it all, we're making new highs. Basically at that point, April 8th, the NASDAQ market was down 20%. The S&P 500 was down 15%. Now they're up about 7-8%. And what's happened? Well, there have been various tariff deals, most recently with the EU, a major deal where tariffs are only 15%, and with Japan, only 15%, although steel and aluminum are 50%. And that's why Canada is sort of left out in the cold, because we could easily, I think, access to a 15% deal, but the 50% on aluminum steel, and that's what he's done with the other countries, doesn't go down very well with Ford or, in fact, with Carney. And so that's why things have stalled out a bit for Canada. But I have a strong view that despite Trump, the stock market made an important bottom October of 22 and October of 23. And that bottom's in place, and a bull market runs till 27. And we corrected about 10% April of 24, 10% the first 2 weeks in August of 24, 4% the first week in September. So the first sort of major minor correction in the bull market was in April, where year to date we're down 20%, 15%. That's a correction. I think it's up from here till the end of the year. And every time there's a tariff deal, and there'll be many more, the market's going to go up. I think interest rates are going to go down, not this week, not this month, but within a year, I think they'll be 1.5 points lower in the U.S. They need to be. I mean, Canada's 4.95 prime. U.S. is 7.5%, doesn't need to be that high. That'll give a lift to the market. And then the tax cut in the U.S., a big, beautiful tax cut, according to Trump, will put more money in consumers' hands, will give more earnings for corporations to have because they're not taxed away, and that'll take their PE ratios down. So I think by the end of the year, the market's up 10, 15%. And we're partly there. We're up 7, 8, 9, but we're not where we're going to be by the end of the year.
So there's a big elephant in the room with Trump, and probably with the rest of the world. It played itself with the EU, and obviously it's a big factor in Canada also, and that's energy. Energy seems to be driving a lot of the boat. How does that affect Canada, and how does that affect energy prices? And the other point I would love you to talk about is the US dollar, which seems to be beaten down a little bit. And obviously it's a little bit vulnerable to all this tariff stuff. But where's the rest of the world going to be vis-a-vis the US dollar when the tariffs all settle down?
Let me start with the second question first, because they're very different questions. That's about the U.S. currency. I mean, most countries, most heads of countries don't want to beat up their currency. Trump does. Trump wants a lower dollar. The bee in Trump's bonnet is really trade deficit. So tariffs are about trade deficit. They think if other countries have to pay more, we'll buy less, which is true. And basically, the whole notion of having a weaker dollar makes our trade deficit less. And so when someone wants their currency weaker, whether it's Trump or someone else, it usually does get weaker. So I think the U.S. dollar, and it's arguably maybe too strong anyway, will get weaker against everything. So against the Canadian dollar, the yen, the euro, that's what Trump wants, and I think that's what he's going to get. And you saw the Canadian dollar go from 67.5 to about 73.85. It's back to 72.88. I don't think it goes a lot higher, but it goes 76 maybe. I mean, that's what Trump wants, I think. About oil and energy, I think we're going to find pipelines are going to be built east-west. They're all north-south. I think a lot of ours, it takes time, but I think a lot of our energy will find itself in other foreign places other than the U.S. Having said all that, I think the U.S. does need our energy, and there'll be some kind of accommodation there that will leave us in a better space than we are right now. Energy prices, I think, don't go up a lot, but I don't think they go down either. I think they're in some sort of stable situation. Even bombing Iran didn't put energy prices up much at all, you know, and they didn't go down. So it's pretty stagnant, I think, in that area. And so that's at least one thing that's pretty good, I think.
Just when we're talking about energy, we have a relatively new prime minister. He has a reputation of being an environmentalist, but on the other hand, a big portion of Canada's economy is in energy. Mm-hmm. And he's obviously battling with the western provinces in order to unlock some of the energy potential that Canada has through pipelines or otherwise. How do you think that's going to go out?
You know, obviously, he is pretty green, I would say, and a lot of the younger generation is pretty green as well. I mean, it's a different sort of mindset. And I think that he's moderated his original views or how people looked at him quite a bit, and certainly he'll be very different than Trudeau, what Trudeau was trying to accomplish. So I think it's a basic cost analysis. Everything has a cost, and I think we'll still be in the energy business for a long time, but the move to environmentally friendly resources is something that's inexorable and will continue.
All right, great. So you have a crystal ball. You seem to have a pretty good crystal ball when it comes to stock picking. So why don't you share your crystal ball with us and maybe look forward a year. And where do you see interest rates?
Yeah, I see interest rates a point to point and a half lower a year from now, especially in the U.S.
And the tariffs won't affect that?
And I think the market will consequently do well, you know, in that environment. I also, in terms of things that I'm interested in, there's certain high-quality banks I'm very interested in. I think they're going to do well. The trading revenues and earnings have been coming, the big U.S. banks have been coming in very strong. They're positioned to take advantage of the world as it unfolds. On the other side, I've always liked and still do like technology. In particular, for example, you know, I'm sort of ahead of the curve and will stay there on AI. I think it's a generational defining movement. And so people will say, oh, it's overvalued because stocks are up. Good stocks go up for a long time, and bad stocks don't stop going down. So on the other hand, you know, you look at semiconductor stocks. You could have owned Intel, which a lot of people did because it looked cheap and it only got cheaper. It's been a horrible stock. Or you could have owned NVIDIA, which I did. You know, when you looked at it 2-3 years ago, you noticed it made 80 to 90% of the AI chips for the entire world. That seemed to me pretty important observation. And its earnings are growing 77%, its margins are 70%, they're booked through 26. And all of a sudden, whatever, Jensen has this ability to twist Trump, and they're selling AI chips into China. So, you know, there are certain movements like banks, which are value stocks, and companies like NVIDIA, and you know, Taiwan Semiconductor, who actually manufactures all that stuff for everyone. There are certain companies like that where you can both have growth and value in a balanced portfolio and navigate the current world pretty well, I think.
So where do you think the Dow's going to be in a year?
Well, I had an assistant who just retired after 30 years with me, and she started in 1994, and the Dow was 3,800. And when she retired, 44,400 on the Dow in 1994. Now, to some people, that seems like a long time. To me, 30 years doesn't seem like that long ago. And so in that 30-year period, the Dow went from 3,800 to 44,400. So inexorably, the Dow goes higher. A year from now, it's going to be higher. I'd say 15% higher than it is right now. And in the future, you know, it'll be 100,000.
Okay, now take your crack at inflation.
Well, I think inflation, you know, the back has been broken of inflation. It's way down. And it would be down further if it weren't for tariffs. I think what tariffs will tend to make inflation go sideways, not up, but it certainly won't decline. But in the end, you know, Trump says, I'm bringing all these jobs back. The kinds of jobs he's bringing back are all going to be handled by robots in 5 years. You know, it's already started. Robots don't have coffee breaks. They don't take a lunch break. They don't take vacation. They're not on maternity leaves. They work 24 hours a day. They don't need lights.
That applies
they don't
to me
need
too,
air conditioning. That's you. Yeah, Mark the robot.
Except I only work 6 days a week.
You know, and what jobs, you know, is he bringing back, you know? And that'll have a damper on inflation because productivity will improve dramatically if you can work in the dark 24 hours a day and you're never sick and you don't take, you know, a lunch break, you know, and everything else. So productivity numbers are going to go way up. That'll keep really, I think, a lid on inflation. But also, what jobs are he bringing back, you know?
Okay, well, that's good. So, Jay, you've been very informative, and I think everybody's taking, like, scribbling notes. Mm-hmm. We're going to get one of these AI note takers to this YouTube. But I would remiss if I didn't end the interview with something which is really the real love of your life, mm-hmm. and that is art. You're director of AGO. You're very instrumental in a lot of the very significant art initiatives in Canada and truly internationally. And maybe you want to tell us what you're up to and where do you see the Canadian art scene moving?
Yeah, I mean, the art market, not unlike the real estate market, was basically fired and went straight up for a long period of time. And it sort of pulled back a little bit here, just like the real estate market. You know, not something horrible, but certainly both markets have paused. You know, I love art because it's so transformational in terms of your outlook on the world, what it says about reality, how it, they were at the front of, part of art was at the forefront of AI and doing stuff, generous stuff, way before it was in the public domain. A couple of things I like. AGO's building a new building. I'm proud of it because I'm capital chair. I raised a lot of the money. It's a $114 million building that opens in 27. And basically it'll show art 1900 to right now. And there's no place in Toronto that has a place to permanently show that art. I think it's really important for the city, the country, to do this building. It's a completely green building. The ability for Torontonians and other people to support it have been quite amazing. So I think that's one big transformational thing in Canadian art and the art of the world. It's Annabelle Seldorf did the building. She was just on the Times 100 most influential people in the world. She just redid the Frick. She redid the National Gallery in London. So we're very happy that she was a vision architect of the project, and that Diamond and Schmidt were the basically building architects of the project.
Okay, that's great. So just in conclusion, I'm going to ask you a question. I'm not going to ask you to divulge your trade secrets. But if I came to you, and you keep hustling me for this, and gave you $1 million today, all right? So you don't have to tell me what stock you're going to put it into.
Right.
But maybe for our listeners, how you would allocate that between equity, long, debt, maybe some offbeat investments, and also allocate between currencies. How would you do that?
Right. Okay. So first of all,
and it's not my last $1 million. Okay?
Okay. I would tell the person, like I continuously tell you, don't diversify, and where there's don't have pockets that are underperforming. Put all your money in a pocket that performs, but make sure that that pocket is diversified. So, although I think I'm pretty decent at bonds and stuff, I would put 0 in bonds here, like a 4.5 interest rate, tying it up for a while. Doesn't interest me. At 8%, that does interest me. At 15 to 17%, I would say don't own any equities, only own bonds, because it's going to outperform your equity return. So right now, $1 million I put, it depends on the person's situation, but let's assume there's more than $1 million behind this investor. Right now I'm allocated about 10% foreign, about 60% into the US, and 30% in Canada. Everyone thinks Canada underperforms, but it really doesn't. It's a top performing market this year. But I just can find all kinds of interesting companies in the US or foreign that aren't necessarily in Canada. Canada's only 3% of world GDP, so I don't need a big commitment there. But what I try to do within my own portfolios is there usually tends to be value investors go for deep growth at the right price, or growth investors who's looking for phenomenal growth, but paying way more for that growth than a value investor pays. My portfolios are diversified in the sense, I believe, that my secret sauce is I look for inefficiently priced stocks, and they can be in value or growth. So largely my portfolios are 50% of each, so they can dampen the downside in bear markets, but you get really steroid growth in a bull market. And so that allows me to navigate various terrains. So consequently, I have different currency buckets, foreign, US, Canadian. I have different investment styles, value and growth or high growth. And I meld all that together to try and beat the index, which, in fact, my 5 models have beat their benchmark in 79 out of 79 periods. 85% of portfolio managers don't beat the market.
So Jay, you were voted like the top Canadian portfolio manager by a recent Globe and Mail survey, and I could tell you from my own personal experiences, you well deserve that distinction. So I want to thank you on behalf of all of our listeners for sharing your wisdom, and we're looking forward to actually a good year in the public markets, sounds like.
Yeah, I'm certainly expecting that and hoping that's the case. And as you pointed out before, no one really knows the future, but a lot of hard work and a lot of intuition, I think, helps you see the future better than other people.
Okay, well, thank you very much.
Thank you, Mark. Always a pleasure to talk with you.